Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, October 30th, 2023. It is 11:02 a.m. Eastern Time. I'm starting the video, so we're about an hour and a half into the trading day. I just want to give you a quick update, kind of recap. Nothing's really changed since last week. Mentioned I went home long for the weekend, figured the RR was worth it. We hit start out here with the S&P 500. Oh, let me just back up. Here's what I'll do. I'll do a brief update on the markets. I already got a couple posts out to you today on QQQ and near-term stuff if you want to actively trade. So I'll go over the indexes quickly. Somebody asked me about TLT. I definitely want to do an update on Treasuries. I very much like Treasuries right now. In fact, just moves a good chunk of money in my wife's 401k into bonds for first time in a while. And gold and silver. Somebody asked about those too, so I have an update to give you. I think gold looks like a nice short setup here. All right, start out with SPY. Nothing really much to add. That's just a beautiful move down to the measured target on that head and shoulders. Has been highlighted for a while here. If you're just catching up, that's it right there. Left shoulder, head, right shoulder. Measured target is your distance from your head down to the neckline. The neckline's just right here. Breakdown. If you missed it, you got an opportunity on the back test, and then boom, hit that. So so far so good, bouncing. And let me give you 60-minute chart. Here's what to watch for on SPY on the 60. I got a post out to you today because we were up really nice in the morning, and I expected a pullback. It was a tradable pullback. That's what, again, if you're an active trader. If you're not, or if you don't know what I'm talking about, if you're new to the site, if I post a 5-minute chart or even a 15, I think I gave you a 15 and a 5 today. That's intraday stuff. That's the realm of the active trader. If you're not an active trader and if you're new to this, don't try to be. Cut your teeth on trading. Swing trading, daily charts and weekly time frames, and maybe 60-minute time frames. Swings that trades that last for days or weeks. The active trader, lives in the world of the intraday charts, and that's 5-minute charts, sometimes down to the 1-minute time frame and 15 and whatnot. So, so far so good on the pullback, and gave you an opportunity to book some profits if you came home long into the day like I did, and then reverse. Gave him a quick pullback on shorts and then get back long again. Again, if it plays out. The pullback happened. I'm doing this video live right now. We'll see. I'm back long again, but we'll see if that plays out. But here's what we need to do on SPY. We've got a nice, on this 60-minute chart, you can see here, a nice little bullish falling wedge pattern. Remember, we have divergence on the daily as well, positive, aka bullish divergence. So let me just tell you in 10 seconds what I think is going to happen this week. I can guarantee you the Fed's not going to hike. That's my as close as I can ever give you to a guarantee. It's also the federal funds futures. If you go to CME Fed Watch tool, you can Google search that. It'll give you the probabilities, which is a near zero. We know ECB's holding tight. Everyone, they're done. And I'll tell you why they're done. The Fed wanted to see a little hot air, in my opinion, the unspoken, of course, come out of the stock market. And they've seen quite a bit of hot air come out of the stock market lately. But what has Powell up at night, or should have him up at night, is what's been going on with the banks. Okay, so expect the usual. No change in rates, and we're willing to stand by. And if we see inflation, blah blah blah, we're not taking another hike off the table. It's all rhetoric. It's actions that matter with the Fed. They flip flop, change. They're always behind the curve. So anyway, that's what'll happen. And so now there's still a lot of red and yellow flags out there. So. I may be wrong on this. The hammer could come down. I've told you before, I am not going home, especially over a weekend, aggressively long or short. The good news is now for futures traders, at least, the weekend's over. Now you can trade normally, so to speak, with stops in place because the futures are liquid 24/7, trading around the clock, or I should say 23/7. They shut down for an hour every day from 5 to 6. But other than that, they're trading around the clock with liquidity, and unlike stocks in the after-hour session, which only use stop or only use limit orders, you can use any type. You can use stop orders, stop loss orders, whatever you want. Market orders at 3 in the morning if that's your thing. Anywho, all right, so that's that, and this would be I expect, and again, I need to choose my words carefully because we're at the point. We've been hitting the red line on the tachometer for so long now that the engine could blow. And what I mean by that is a fund, a hedge fund somewhere, a bank, a non-bank financial, anything that could have ripple effects throughout. Because all it takes sometimes, you don't realize one seemingly little thing blows up, but then there was a hedge fund or someone invested in it that was overly leveraged, and then that causes that to blow up and cascade, which then causes something else. So there's that, the financial markets are very, very complex and interrelated, and sometimes something seemingly innocuous can have a ripple effect. And so I cannot eliminate that all of a sudden, just when things look good, like today, we start out with a nice rally. Markets are open now. Everything's normal. We've been positive all day on the Nasdaq and the S&P 500. So far so good. But again, I just want to throw that out there. What does it mean at the end of the day? Be careful. That's all. I expect I'm positioned long still. I'm expecting upside this week, but I'm also, like I like to say, driving with one foot on the accelerator and the other hovering just above the brake, ready to, if something doesn't seem right, get out of those longs and maybe get back short. Right now, I'm not seeing it. I think there'll be a upward bias on the market this week. It could be a pretty good one too. We could be looking at a pretty nice counter trend bounce. So the RR, if I didn't think it was favorable to be long, I wouldn't have gone home long. We hit that head and shoulders target. You have this bullish falling wedge on the SPY. Measure target on a pattern like this. You take the widest part of the wedge, which is about right there. I'm just free-handing it. That would take us up somewhere in here. And what would that be? And I'm just eyeballing it. About a 4% rally. But I always say this. Resistance is resistance until unless broken. So that was, I didn't get, when I get charts out to you like this morning that are time sensitive, I can't include every single thing. That's why I do these videos. I'm going to do that. So that's why I expected a pullback coming up to those resistance levels. Well, based on those charts alone, again, I gave you the QQQ, NASDAQ 100, and the SPY was just kind of showing the bounce off support on Friday off the head and shoulders neckline target. But you also had at the very same time at the highs today, this is today's price action. You don't know what we're looking at. This is yellow, that's Friday's close. There's today's gap up right into a nice downtrend line, which forms the top of a bullish falling wedge pattern. So this breaks out. I'm going to move this line right here. I've had this one here for a while. I need to take that up right there. Okay, so there's your first target for SPY traders. And not just SPY traders. Let's say you're trading only NQ or QQQ right now or anything else. You want to be cognizant of if and when SPY gets there, because the SPY traders are probably going to step in and sell, and the ES, S&P 500 futures traders. And guess what happens when they sell? Proportionally, Apple, Microsoft, Alphabet, Amazon, the same top holdings in the NASDAQ 100 are the same top holdings in the S&P 500, so they get proportionally sold out too. So in other words, these guys are interlocked. They're very much related, a lot of overlap, especially and most importantly in the top holdings. All right, let's move on. All right, that's that. QQQ. We have, what do we have here? T2 so far, we're checking them off. T1 hit back here, or maybe it was all the way back here. Yeah, it was back there. That came a key level. We broke that. Then T2 was hit last week. We undercut it slightly, but as I talked about, when you turn off all the horizontal lines, all my annotations, we also hit the 200-day, which is where, as I said repeatedly last week, I think I would be surprised, not shocked, but surprised to see, the markets just go on through the 200s like they're not even there. So far we hit them, and, we all see what we want to see. I'll recognize this. Maybe that's a little bear flagging action with an impulsive move down, flagpole, but I don't think so, like I said. And here's the thing too, let me just dumb this down a level or two. It's simple, to be long here. If you went home long last week on Friday, a long entry or long position with a stop above the recent lows is objective. And I can even see the possibility this week. I'm not favoring it, or I wouldn't at this very moment be long. But then again, you know me, I'm came in the day long, short, long again. That's 5 minute stuff. That's active trading. But where I'm going is you still have the 200 simple just below, and that would be a great head fake to pull it down. One more thrust down this week before the Fed meeting. We have some employment numbers coming out on Friday, but I think what's going to happen is we already know it's priced into the market. The Fed's not going to hike. I think when they hear it, you could get a decent relief rally. Maybe not. And that's why stay flexible. Might be a sell the news kind of event here. All right, so that's it. T2, we're right there. We're above the 200s. Again, turn off all the lines. 60-minute chart. Let me go down to that. I think this is what I gave you today. What board was I using? I have so many boards here. This is a 15-minute chart. We had a divergent low here, which we gamed and went up. And we had a couple targets there. Final one being that downtrend line. Divergent high went down. And most recently, let's see, was that a divergent low? I don't have the lines drawn. We have divergence there on the RSI. So, I'll have to say that the 15 and even the 60s kind of look on QQQ a little bit icky, if you will. In other words, I'm not in love with them. We're kind of in no man's land. You can see, I don't know if you can see it in the video, I have volume price histogram bars. A lot of the trades occurred in this range right here. And this is a thin zone. And we dipped into the thin zone last week and we're back testing. So like I said, it can go either way. I'm telling you at this very moment which way I think it's going to go, at least near term. And let me get to treasuries in a second. I like the RR on those. The price action isn't great, but I'll get to that in 1 second. It's not bad, but it's not what I would expect it to be right now. And maybe as we get closer to the Fed meeting, Fed announcement, we might see treasuries pick up. What else did I want to go? Oh, yeah, let me give you the futures. Let's do that. Okay, so this is what I got out to you today. It is a 15-minute chart of NQ, NASDAQ 100 futures. Nice downtrend line right there with numerous reactions. 1, 2, 3, a little spike through before 5 because we felt closed back on it. Multiple reactions. Anyways, that's there, but at the same time, we were right here. That's when I got that out to you. We had SPY running into its comparable downtrend line, and there's a great example. NQ traders, if you're only looking at NQ and you're not looking at and also QQQ, even if you trade NQ, you want to also watch QQQ because sometimes it hits comparable resistance level, and we'll get to that in 1 second. So there's the pullback. And that was the first support. There's a second support. Those were on the chart, and that's why they bought it. They didn't buy the first one. Got a little bit more powerful sell-off, and that's it shows me. It gave me a little bit of a tell. Boy, there's a lot of trap longs waiting to get out, like trap rats trying to jump off a sinking ship. Today's move out of the gates was pretty impulsive, and then met with an equally impulsive sell-off. So this is a 1-minute chart of QQQ. Let me turn off all the lines. So there's where we opened down here, gapped up. We were up 1.5%, and then boom, they sold it pretty hard. But it still stayed positive. So at the end of the day, we're still positive right now. What gets ugly? A break of probably put a little uptrend line off the recent lows right there. Violation of that trend line would be the first cause for concern. Then that's where we hit on Friday, last when we closed out, or no, it was right here Friday, but there was Thursday. Remember, this was the test of the 200. So we're still in that proximity. And I think, I don't want to call it worst case scenario because worst case scenario is a market crashes. All right, let's just not, that has not been taken off the table at all for me. The potential out of the blue of a market crash. I think the odds are lowest on that. I think, so other than that, the worst case scenario, I think this market slogs around, bounces around these 200s, rallies, gets sold into until the Fed meeting on Thursday. I think that's to me, again, not worst case, but second worst case scenario. And most likely scenario is we drift upward into the Fed meeting as more and more folks realize the end of the rate hikes, or at least for the time being, foreseeable future, are over. Is it too late? Has the damage already been done? I've spoke to that. I believe fundamentally, absolutely. I'm not looking for move to new highs. In fact, I'm probably going to. I've all but have eliminated that scenario in my head. Based on the recent price action, not just in QQQ, but everything else. And I'm talking about, again, if you're new to the site or just catching up, for a while back here, this has always been my alternative scenario, calling it, a move down here, and most likely that this was the end of the bear market rally, and we'd be going lower from there, with the possibility, which was a near-term bullish but still longer-term bearish call. So I've not wavered on the longer-term bearish outlook, but near-term that we had the possibility, especially when we had bullish divergences and all that back here, 60-minute chart, that we could go up and make a marginal new high. But based on what I've seen and where a lot of sectors and the banks and everything else and the non-financial, the non-bank financials and just every other sector, home builders, I could go on and on and on. I don't think that is at all a decent chance anymore. Anything's possible anytime in the market. I mean, hell, a run to new highs and 30% upside from here is possible. It's just not probable, in my opinion. I only trade probabilities in the market, not possibilities, because anything's possible. All right, so that's where we're at. I think we're good to drift up this week. Today, I think once they battle out and you shake out the last of the weekend of longs today, I think it'll be smooth sailing, and I'm going to be less and less interested in gaming pullbacks going forward. This is Monday, so you had a lot of trapped shorts that came into today, trapped in this move down I'm talking about from over the last couple weeks, that took advantage of today's bounce to get out. That's what I think happened. I think that starts to dry up, so you get those last of the the longs that realized they shouldn't have been long and wished they were just praying for especially in the last week or so, they were praying for a decent bounce to get out. I think that's what was hit with selling this morning when we were up 1.5%. So that's kind of my feel, kind of going off that plan now, but let's look at the technicals and I'll move on. Let me make it not too long of a video. All right, this is a big part of what I'm looking at here. I'm on a 60-minute chart. This guy reports, this is Apple. We all know this guy or this stock. Crowd favorite, largest component of the S&P, largest of the QQQ. I've highlighted this. It never took out, which unless all these purple lines, my key levels are taken out, I can't get overly bearish. And, kind of what I refer to as short the market hard and throw away the key kind of thing. When I say throw away key, no, I'll always have stops in place if something crazy happens or the technicals change. But for the most part, kind of go into swing trade mode, looking for the next big leg down. But those lines were there not because they were random and arbitrary. They're support levels. So support is support until it's broken. So here's Apple. Let me just summarize this for you in a nutshell. Down since the peak back in July. The world's largest publicly traded company has dropped almost 17%, including a big swoon down there, and they're scheduled to report earnings coming this Thursday. So from my experience, being that we've already had a pretty big move down, at best this is probably going to chop around. Again, being a crowd favorite, beloved stock, and not to mention one of the most bullish charts out there. I will say this, and I've been saying it. Especially if you're bullish, or even if you're a market agnostic, meaning I don't put that in my head. I don't use the words bullish, bearish. I just trade the charts. Well, you have the first time in a long time, nice, clean, distinct positive divergence on both indicators down here, the RSI and the PPO. So you have, and there's a downtrend line right there on Apple. So Apple has a great technical setup. If it's a bear market, what tends to happen is these textbook-looking bullish setups just don't play out. Or they do. They start to, and then just as they look like they're getting going, that's where it fails. So I can't tell you, and I will not be taking Apple personally into earnings. I just won't. It's too big of a risk for me. But if it just waterfalls down. Imagine this is not yellow but a red, big red candle after earnings, and just drops, and that's out and out bearish, and then kind of get out of Dodge in the market if you haven't already, in my opinion. However, if it pops up, you still have the beautiful bear market downtrend line, which is a target. Maybe this would be an after hours, after they report Thursday after the close, you pop up there. It would be roughly, if I grab too close, I move a trend line. I'm going to just grab there and go a little higher. 5% pop would take you right to the trend line. And then, of course, a break above the trend line, at least for Apple, it's going to be bullish. Now, I don't know if the breakout would fail, and that's my guess, guys. So I think it's a textbook-looking bullish setup. So let's just say it does rally up there. That's an objective short entry at the trend line. If it breaks out, that's not an objective short, but if the breakout fails, that is. At the point a breakout fails, that's when it's an objective short. And anything more than that, if Apple breaks out, I'm going to go over all these things for you and tell you levels to watch. I don't think it's going to new highs, but I'd be a fool to not point out these levels and recognize those. Microsoft had almost an identical pattern, but they already reported, so it's ahead of Apple. So it had a divergent low, at least on the PPO, almost a slightly lower low on the RSI, but close. And then it broke out. Pre-earnings, back tested, then pop post-earnings, faded the post-earnings pop, but it's still above the trend line, and it also got rejected on that 341 resistance. Alphabet still holding that. Remember, you had both the 200-day, this red line here, 200-day exponential moving average, and a very good support zone, and it's holding that so far. We rallied up to that. Remember, these support levels, support once broken then becomes resistance. So we had a rally into that, and that's where the buyer or the sellers stepped in, as they should on the initial reaction. But I still like this one. I think unless the market craters this week or following the Fed and Apple, which is certainly a possibility, I think you can. This one offers a little more upside than some of the others. Amazon, look what happened to Amazon. Remember this one? I said going into earnings, if you want to play the guessing game, that you had a trend line here, support plus the 200-day simple moving average and positive divergence, a lot of check. And so that one actually bucked the trend. And now look, they took out the trend line right there. And you can see that trend line on the 60. So that's just looks just like Apple, what I just showed you, a little 60-minute bullish falling wedge with positive divergence on the 60-minute. That Apple has, and that's what Amazon had, and that 60-minute divergence has played out. So it's the same thing I was repeating last week. We have multiple key market-leading stocks. Yes, they've been getting the snot beat out of them lately, but most, if not all of them, have just hit major support that's good for at least a reflexive bounce, and that's it. That's kind of what I'm trying to convey, a tradable bounce. How far that bounce goes, we'll have a whole lot better idea come Friday, because the Fed will be out of the way on Wednesday at 2 p.m. Apple will be out of the way Thursday after the close, and we'll know which way this market goes. So I am leaning towards an upward drift this week, leading into and through the Fed, post-Fed. I think they'll say enough not to spook the markets, because in my opinion, again, unspoken, but I think they should be worried about the banking sector and the financial sector as a whole. I know, and they claim inflation is one of their biggest, the biggest focus right now for them. But if the banking sector implodes, you got a whole lot bigger problems than a loaf of bread going up 20 cents over the next year. That's my thoughts. Okay, let's change. Let's move on. Again, the markets, the risks are they were heading into the weekend somewhat bilateral, but skewed to the long side. And that's so far so good. The day is not over. Somebody asked me about treasuries, and my reply is nothing's changed in the technical outlook or my own outlook, with both being bullish. Now the trend is bearish. You might say, Randy, are you smoking some what's bullish? The trend, and again, this is hindsight stuff. This is the margin of the chart is right here. That's why I named the site right side of the chart. This is what hasn't happened yet. That's the future, and that's what I try to predict. So I take what's on the left. It does no good and tell me something's in a downtrend right now. what matters to me is where it goes from here. So I still like it. What I said is, the price action's been kind of muted. We're not moving up impulsively, but since I gave you, it was 2 weeks ago, I think, I gave you this bullish falling wedge here on the 60-minute chart with a buy signal coming to breakout. So you had a breakout, a back test. And we have been moving higher. An uptrend is defined as a security making higher lows and higher highs. It's not a solid uptrend yet, but here's our 3 higher lows, higher high, about an equal high there. But as I've been saying, I think the RR is favorable, clearly favorable, because remember, if you get into, let's say, natural gas is a great example. You get into natural gas too early. I still think it has a bullish long-term setup, but I've been saying that since back here, and I still maintain that. We put in a divergent low, and we've been higher. That was the low. But what happened? We went into a trading range, and I point out we need to break T2. I've been saying that we hit T2 back here, my second target. I had my next target up there. We need to take it out with conviction, and that hasn't happened. So where I'm going with this is the dividend on natural gas is 0. They're paying you squat. They don't pay a dividend. It's natural gas. It's a commodity. And there are other stocks, a lot of stocks don't pay a dividend. So my point is, when you get in, had you gotten in early, it's been trading sideways for all year right now. And so, if you bought the divergent low, you're up a little, not much. And that's all you have to show for it, whatever measly gain or break even you have. However, Treasury bonds are paying 5% interest. What is it? TYX is the 5.5 on the 30 year, and 4.9 on the 10 year. So that's where I think the RR is very good. I see. Just go back to the trade. So there's, I'll give you multiple targets here at the each of these levels. I think at least we'll come up to this downtrend line here. So this trade is primarily based on potential for capital appreciation. But where I'm going is, let's just say this continues to kind of just slog around, right? Again, you're getting paid annually, 5 plus minus %, whether you're going with the 10 or the 30 year, to sit there and wait to see if the chart plays out. You also have, as I said in the follow-up to it's in one of the comments from today, I think, my reply, but you also have, so we already have the buy signal that triggered a couple weeks ago on the 60-minute chart, and we're slightly positive on the trade, but you also have this bullish falling wedge. I think I pointed out to you on Friday, sometime last week, nice positive divergence. So, and what did I tell you? I think I said 10%, is it, capital appreciation if this T1 is hit, almost 10. And then you have the potential T2, the downtrend line, which would be, again, if and when hit. You have to say that because downtrend lines are dynamic. They come in at lower and lower price levels every day. But that could be good for about a 14% gain. So I can tell you now, I don't plan to hold treasuries for a year. But if I had to, and again, I look at the chart and I think the downside on bonds is limited. And it almost has to be. And if we do continue lower, that means yields are going higher, and I can tell you the stock market will crash. So whatever's going to happen, I don't know if Powell, he's been kind of mute lately on the whole quantitative tightening thing. I haven't heard much there. Markets would explode if the Fed said they were going to back off a little or ease up on the quantitative tightening. I don't know if that's going to happen. And this is the here. Let me show you on weekly chart. And this is again a weekly chart. You now have negative divergence here on the RSI, which I just drew for you. I had already highlighted it here. I had it drawn on the PPO. PPO here. You can see the divergence is steepening. So guys, this sets the stage for potential pretty good trend reversal. I have been and remain unwaveringly bullish on rates, which is bearish on bonds, since back here in COVID, saying emphatically that it was almost criminal for how these banks got caught and blew up, all the regional banks holding long dated bonds in their portfolio, because as I said, when rates approach near zero, you had nothing. It was 100% guaranteed that you had no upside on bonds back then. The most upside you had is if interest rates stayed near zero for indefinitely and you collected the paltry, 0.8%. They were paying below 1% interest, the 10-year back here, or this is the 30-year, I'm sorry. And so you had a virtual guaranteed losing trade, and it amazes me how many institutions and the banks and all that were buying and holding, long dated treasuries. But all right, so where I'm going is, we broke out. This is a secular primary bear market downtrend line, I believe, and I've made the point repeatedly before and after that this is a new early bull market in rates, yields and rates, which means a bear market in bond prices. However, nothing goes up forever. What I see coming is in bonds, a bear market rally, which means yields go down, bonds rally. Like I said, pretty big divergences there. That's TYX, that's the 30-year yield. So the yield will probably come down somewhere in here. I would say, right here, about, drop to that 41.65. The way you look, just move the decimal over, and that gives you the rate. That'd be 4.165% TLT. And again, so if I'm wrong, it's a strong technical chart. That would be, on TLT, when I go, this is a weekly, guys, I know I'm all over the place, but all right, so the two scenarios here. This is a key uptrend line on TLT off the 03 lows, just to back test that trend line, which is a minimum target on the weekly. If I'm trading off the weekly, I would say right there, and that's that 10% I told you about. That's my minimum target. And I could see the possibility of a little bit more, but let's just get that. You get 10%, and if it happens, I think it'll happen pretty quickly. That's swing trading. You get 10%. If it takes us a month, you make 10% a month, sell it. If you could do that every month, you're annualizing, non-compounded 120% a year. Now, I'm not trying, don't get overly confident. Just because I think that's what's going to happen doesn't mean it must. Bonds, the whole thing can blow up. But I can tell you this, we've been pushing the needle also, as I've been talking about, that whole redlining on the economy thing and interest rates. If rates go much higher, it's Armageddon. Just short whatever you can short, and go buy some guns and butter and get in your bunker, because the economy cannot sustain. Ultimately, we're going to get there. You might say, Randy, you just said you think rates are going longer over time, but you can only do so much so fast. Any big move up, to here from 5.5 on the 30-year up to 7.5 would just absolutely annihilate the economy, collapse the banking system. It's not going to happen. The Fed's not going to let it. To whatever extent they can. Remember, they don't directly control long-term bonds. They only control the federal funds rate, short end of the curve, but they can manipulate the bond market via quantitative easing, tightening. Believe me, it would be a global central bank concerted effort. So that's it. Enough rambling there. I like bonds. I think it may be time for a tactical trade in a 401k. That's what I'm doing. We'll give it a little, patience. I have room to add. I'm not all in, but pretty hefty position and room to add, and that's it. So long equities, long bonds, and the last one, somebody asked about gold, GLD. Nice looking. I said gold is an objective short entry on a break of this 60-minute chart we're at. Bearish, beautiful bearish rising wedge. There's your uptrend line. Lots of clean reactions on it. There's your again, this is just a 60-minute chart. Divergent high right here, i.e. negative divergence. We've been diverging, started the divergence here. It continues to steepen. You see the indicator severely lagging. Gold's been catching a flight to bid, a flight to safety bid lately, meaning institutions been worried, and they haven't been buying a whole lot of treasuries. Treasuries are up again. Let's downplay that. We are positive on that trade, and it's a trade again that pays interest in addition to any capital appreciation. But as soon as we get that market rally, if there's a relief rally when the Fed says they're done for now, especially, and this is a big asterisk, it would really help Apple to support the case. But I would like to be out and maybe flat. I'm just speaking 3-4 days ahead right now. I plan right now to have a net long bullish bias going into the Fed meeting and after. But then depending on where Apple, Amazon, Microsoft, QQQ, SPY, ESNQ, where they all are, I would like to be, especially if they've rallied up and hit some of my targets that are at resistance, I'd like to be out before Apple reports, because ultimately I think we're going down, and we may not get there. Again, guys, I'm trying to talk out 4 or 5 days ahead right now, just kind of mapping out a rough game plan. But if we turn around today in the market, oh, by the way, my targets sorry, I'm going to move on here. I'm rambling. 182. I haven't set hard targets. I'll align this. I'm going to move this line up right here, borrow that trend line, maybe down to about 181. I'm not looking for anything huge, just pullback trade on gold. And of course, silver as well. This is gold futures. This is a 6-month chart with 2-hour candles we're looking at. The downtrend's not as clear. I have this near term. This is probably that same trend line I just gave you on GLD right here, this uptrend line. So forget about that first one I drew. And there's your divergence. You can see we've been building some big negative divergence, just like we had positive divergence here, and we were bullish and long gold at the bottom there, and positive divergence here and pop. So anyways, that's it. Bearish and short gold. Silver, to be bearish on gold is to be bearish on silver. It just tends to fall more when gold drops and rally more when gold goes up. And I think I'll wrap it up here. Yeah, we're 36 minutes into it. I wanted to keep this one short. Let me get it out to you guys. All right, if anything changes, and it may, again, expect some back and forth volatility this week. The VIX is still high. I'll let you know if I change my outlook or if I see anything that I've missed. That's what I do all day when I'm between these videos and the posts I give you. I comb through hundreds, if not thousands, of charts a week, looking at all kinds of things to see anything that stands out that might help support a bullish or a bearish case, and not just the stock market. That's, of course, then I'm looking at other things as well, commodities and everything else. So all right, let me stop here, get the video out to you, and I'll follow up with something else later today. This has been Randy Finney with Right Side of the Chart. Have a great day.